What is going on with the Federal Reserve and mortgage rates? I know talking about mortgage is like watching paint dry, but this should help you understand what is going on and why. Why is the Fed doing what they are doing? Why are rates high? If you agree, disagree, or have your own opinion, I would love to chat. Leave a comment, like, and subscribe. We don't have an equity problem, we have a rate problem. How do we get to lower mortgage rates? Well, right now, the Fed is not happy with inflation. Mortgage rates have always followed inflation. The reason why is because mortgage rates are a long-term bond that someone holds that is getting a fixed payment every month. So if inflation goes up to making prices go up, then buying power is less, and that causes the price of that fixed payment to lose value. The opposite happens when inflation is low, and that helps long-term mortgage rates. Inflation was at around 9.1%. The Fed's preferred inflation measure, the Core Personal Consumption Expenditures Index, is currently 3.9%, which is nearly double the Fed's target of 2%. But it is the lowest annual increase that index has seen in 2 years, and is seen as a positive step towards the Fed's target. The next rate setting meeting by the Federal Reserve will be October 31st and November 1st. So you think, wait a minute, if inflation's down, why are rates so high? Well, people have been moving their money out of bank deposits and into money market accounts because when the Fed raised the rate, you're now getting over 5% in a money market account versus 1% in a bank deposit. Why does this matter? Well, when you deposit money in a bank, they use that money to loan to other people, like car loans, personal and business loans, just to name a few. They pay you 1% and make 5 to 10% using your money. But they also use that money you deposit to buy mortgage-backed security bonds that give them a higher rate and they can sell or make liquid. They can't go to the person they gave the car loan to and say, we want the money back, so that they can give the money to the person that's withdrawing the money from their bank account. So when people started to flee banks because they would get a higher return rate from a money market account, banks had to start selling their mortgage-backed security bonds to get people their money. While this was all happening, I had a conversation with an Edward Jones rep. His business was booming because people weren't moving their money from bank to bank, but from bank to an investment company like Edward Jones, Charles Schwab, Fidelity, just to name a few. So banks had to sell their mortgage-backed security bonds to liquidate so they could return the money from the people that were withdrawing money from the bank. Then you add the SVB, First Republic, and Signature Bank failures. The FDIC took over those banks and sold their assets that included mortgage-backed securities. Another factor was when the debt ceiling was raised to $270 billion. Where do they get that money? Well, to get people to buy them, you have to offer a higher yield, and when rates on treasuries go up, mortgage rates follow. The 10-year treasury yield surpassed 4.9% on Wednesday for the first time since 2007. Mortgage rates tend to track the yield on 10-year U.S. treasuries, which moved based on a combination of anticipation about the Fed's actions, what the Fed actually does, and investors' reactions. When treasury yields go up, so do mortgage rates. When they go down, mortgage rates tend to follow. While the Fed does not set the interest rate that borrowers pay on mortgages directly, its actions influence them. Then we add when Fitch cuts U.S. credit ratings from AAA to AA+, and just like us, when our credit rating is worse, the rate is a little bit higher. Now, here's a chart to help give us an idea what rates will do and why we think rates will go down. The green is the 30-year fixed-rate mortgage average. The blue is the market yield on U.S. Treasury at 10-year maturity. The red is the Fed rate. The gray areas are when we hit a recession. We can see when we hit a recession, the Fed cut the rate. The yield went down, the mortgage rates followed. Remember 2008? So why does the Fed raise and lower the Fed rate? The Fed raises the federal funds rate as a tool to manage the economy, control inflation, and promote financial stability. When the Fed raises interest rates, it typically does for specific reasons, and the impact on the economy can vary. Raising the federal funds rate can have several effects on the economy. One of the primary reasons the Fed raises interest rates is to control inflation. Higher interest rates can reduce consumer and business spending, which can help slow down inflationary pressures. By adjusting interest rates, the Fed can influence the overall health of the financial system. Lower interest rates can encourage borrowing and investments, but they can also lead to excessive risk-taking in financial markets. Raising rates can help promote stability. Higher interest rates can encourage people to save more money in interest-bearing accounts, which can have a positive impact on personal finances. However, it's important to note that raising interest rates can also have a negative effect on the economy. Higher interest rates can make borrowing more expensive, which can lead to reduced consumer spending, particularly on big-ticket items like homes and cars, but also take a look at your credit card rates. Higher interest rates can also discourage business investment as it becomes more costly for companies to borrow money for expansions and capital investment. The housing market can be sensitive to interest rate changes. Higher rates can make mortgages more expensive, potentially slowing down the housing market. Whether raising interest rates artificially causes a recession depends on the specific economic condition at the time and how the Fed implements its policies. If the economy is overheating with high inflation and excessive risk-taking, raising interest rates can be seen as a necessary measure to prevent a future economic downturn. However, if the economy is fragile with high unemployment and low inflation, raising interest rates can potentially exacerbate economic problems and even contribute to a recession. In summary, the Federal Reserve raises interest rates as a tool to influence the economy, and the impact on the economy depends on the broader economic context. It is a complex and carefully considered decision, and its effects on the economy are not necessarily artificial. The goal is typically to achieve stable economic growth and price stability. If you have your own opinion, a comment, or have any questions, contact me. I hope you have a wonderful day.